she was gonna like give them back to us, I think tomorrow. But I'm gonna catch a Bulls Pistons game.
Okay, hello everyone. I apologize for sending out a confusing announcement on the midterm. Everybody on board, the midterm is February 25th, Wednesday, 3 weeks from Wednesday. Right, in this classroom, regular classroom. I'm sorry about that. I tried to send out a clarifying email. I did that purposely to move you guys off of, I think that allowed. We'll talk more about the midterm as we get closer to it, how to think about that, and prepare for that. I did want to point out the Beta Alpha Psi presentation on Wednesday. This is a professor from the data analytics group. I just want to stress to you that data visualization, packaging and storytelling around a particular issue or planning idea that you may have is a skill set in and of its own. You can be the smartest person, but if you can't convey complicated material to your supervisor or your client, you are constantly going to be battling things in the business world, trying to move things forward, or sell work, trying to get I always thought of myself at PwC that I was kind of the focal point for my clients. I wasn't the smartest person in the room, but I was delivering the firm with plenty of smart people to my client. I knew how my clients like to take information. So I could take things very complicated, or I strive to make them understandable, not dumb them down or simplify them so much that they don't appreciate the complexity. The art here is to convey the complexity, but make it where it's not overwhelming. And we can still do this. It's going to cost you. It's going to be expensive because it's complicated, but we can get this done. That is through a visualization tool. Now, I didn't do a lot of the things that they're talking about here. We were using Alteryx a lot, and so that was just coming into our practice with young people who were driving that. But all of these types of tools, I mainly use PowerPoint. Was my medium, but anything you're doing to try to take something and distill it down to where it's actionable to a superior or supervisor or a client, you can never get better. We can all get better. I think that's the thing that AI can do, that communication element. How do you take all this and communicate to a client? So anyway, be well worth your time, I believe. Okay, our goals today is to finish chapter 3. Okay, so we're going to finish with 1231 assets. And then we're going to do tax-deferred transactions. I'm optimistic we can get through all that today. Those of you that were in individuals, much of the tax-deferred transactions we're going to talk about is going to be new material that you already know. So I'm going to go through it. I think it'll still be useful for you because the concepts behind why something is deferred and how we keep it deferred is so important from a tax planning perspective. I want you to hear it again, and so we'll be able to go through that fairly quickly. We're going to start with 1231 assets. Remember what 1231 assets are. It's the column is property used in a trade or business, and the row is held for greater than 1 year. Okay, and it's green. It's the best of both worlds. Meaning, if I have a gain, it's long-term capital. That's important because some of our business entities are flow-through. And if it's flow-through to an individual, individuals like long-term capital. Tax preferential, right? If it's a loss, it's an ordinary loss. Best of both worlds. That's the best thing I can do with the loss is offset ordinary income. So that's why we spend so much time on 1231 assets. So I want to pick up with, we talked about depreciation recapture, but there are 3 areas we call where I could have the gain, because remember I'm starting with my initial basis, initial tax basis, and I start, if it's used in a trade or business, then I can depreciate that and recover some of that basis through taxable income via depreciation deduction. The consequence of doing so, I have to reduce my tax basis from my initial basis to what we call adjusted tax basis. Okay? When I subsequently sell something, right, remember in the first part of this chapter, amount realized less adjusted tax basis, gain or loss. If I have a gain, some of that gain could be created just by the mechanic of reducing initial basis to adjusted basis based on depreciation. That's the first one here. Gain created solely through depreciation deductions. My second possibility is I could have gain generated through both depreciation deductions and actual asset appreciation. Right? So some of my gain could be attributed because I wrote down my basis to adjusted tax basis, but some of it could just have economically appreciated in value. And then 3, I could have a loss. Right? Not everything's sold at a gain. So we went through the first one, which was the gain recognized was $71,000, and it was fully created by simply taking $381,000 in deductions. Right? So my gain was less than my depreciation, so that all of my gain was created by depreciation deductions. And that would, because that's my depreciation recapture, meaning that my gain does not stay capital. It goes back to ordinary because I'm recapturing the depreciation deduction that reduced prior ordinary income. Okay? I don't get the best, I don't get the double dip, meaning that I don't get the take deductions of ordinary income by depreciation deductions and then turn around and create a gain solely by depreciation deductions and treat that as capital. Okay, so our second one is gain created by both depreciation and economic asset appreciation, and this is, did we do 3.6? Did we do this example? Why don't we do 3.6? Just pause. Sorry, Esmeralda. Edmund, you want to do 3.6?
I suppose. Oh yeah, this one. Yeah, I saw it was 3.
I think it'll give us the whole picture because I want you to compare and contrast those 3 alternatives because then I think if you keep those straight in your mind, you'll be able to understand depreciation recapture. Okay.
So for 3.6, as indicated by this what are the amount indicator of the gain tax recognized on the sale? So like first, like the amount realized is 300K, and then the original basis as on the previous question is 610K, and the accumulated depreciation is 381K. So the first thing they did is to get an adjustment basis, which is the one like they want to calculate the values of that adjusted basis, and then we recognize a gain and loss of 71K.
So let me pause you there. So we got to be very process oriented in this. So he covered amount realized, then he covered adjusted basis. And technically, the next step is that's our gain, our loss realized. Then is there an exception? We'll talk about the tax deferred stuff, but assuming none of that applies, then it's recognized. Now we're in characterization, right? We're done with the amount, we've computed it. Now we're just gonna, how do we treat it for tax purposes? Okay.
And now we want to characterize this as ordinary income because it's all cost in 1 to 4 by the so it should go directly to ordinary income instead of recognizing as capital. So that's why like this is treated as ordinary income. And there should be no capital.
Correct. So then all the 71,342 gets reported as ordinary income, not capital gain. That would be important, I'm assuming here Teton is a flow-through entity. So it might be going out to individuals, which we have to tell them what's the character of their income, because they have to put it on the tax return. Take us through the last one.
And the what if situation says that will it be a demand of character of having gain without breaching the capture rules? So that means that it's not characterized as 1, 2, 3, 1 gain again, so it would not be flowing through ordinary income, so that would be recognized as a capital gain. So in this case, this will be categorized as capital gain.
Yeah, long-term capital, right, the intersection of the column and the row. And so depreciation recapture prevents this preferential treatment because you already got the cost recovery. Okay, 3.7. Got this one. So now we're going to have gain that is partially created by depreciation that we've taken in the past, and partial actual asset appreciation.
So we're assuming the same facts, so we just saw in example 3.6 and exhibit 3.2, except 1010 sells machinery for $620,000. What are the amount and character of the gain 1010 would recognize on this sale? So the answer would be $381,342 of ordinary income under the 1245 depreciation recapture rule, and $10,000 of the 1231 gain due to the asset's economic depreciation computed as gain. So that would be 620,000 amount realized, 610,000 original basis, with accumulated depreciation of $281,342. Then the adjusted basis of $228,658, with a gain recognized as $391,342. So then that's the ordinary income of $381,342, with a 1231 gain that is $10,000.
And so you get there, line 6, because it's the lesser up, right? So you had depreciation recapture. The total amount of depreciation was 381. Right? So that's the max that could be recaptured. You had a gain of 391. That's the incremental 10,000 that's above and beyond that, meaning that the actual value of the sales price is appreciation that is afforded 1231 treatment, and that 10,000 then, right, would be long-term capital. We have a big chunk of ordinary income we would report, and a small piece that would be capital. Thank you. Okay, now we have sale at a loss. 3.8 is you're wrong. So you see the common theme of this. What's the amount? What's the character? It's very much like an exam question. Tell me the amount and the character.
In example here, for 180,000, the original cost of the which is 610,000 minus accumulated depreciation of 381 and 242. So the adjusted basis is 128. The sale price of 180,000, which is below the adjusted basis minus the adjusted basis of 128. So you can recognize the loss of 48,658. Since the depreciation recapture under section
All of it's 1231 loss, right? And so what's the end result of that is ordinary, right? The best of both worlds on a 1231 asset is you get ordinary loss treatment and it's reported and maybe okay? So it only applies to gains, and you're looking, is the gain created by the accumulated depreciation I've taken, or is there some actual, real or actual economic? Thank you. Yes, Arthur?
I want to ask about potential inflation illusion. So, the asset might have been bought 10 years ago, so the gain might be a gain on paper.
Yeah.
Economically, it's
Yep.
not really
Good question. So, fortunately or unfortunately, depending on how you want to administer the tax code in the future, the U.S. does not make adjustments to basis based on inflation. So the inflation or the basis is your initial basis when you pay for it, right? So I think that's real. That's intuitive in buying stock. So if you buy a stock for $1,000, that increase the price that you paid. But if it's a non-stock asset, you could think about, well, should that basis be adjusted for inflation? Because if not, some of your gain is just going to simply be inflationary gain. It's not real asset gain, right? It just costs the thing cost $1,000 5 years ago don't cost $1,000 today. They cost more, right? So unfortunately, the U.S. does not make that determination. I don't know if they still do it now, but Mexico in the past, I've dealt with them where they did try to have inflationary adjustments, and it was just a mess. It was just so hard to think of all the assets in the economy. You're gonna talk about full employment for you guys. Sitting around doing inflationary adjustments every year, or probably what people would do is they wouldn't do it at all. They'd sell it, and then they'd have to go back and determine their initial basis, and then do inflationary adjustments from there. But for right or wrong, inflationary gains can't be taxed.
Like on the exam, will we be required to like kind of identify if it's a 1231 asset or not? And like, if so, like would we get this like almost like this table, or should we like kind of look to try to see?
I would think you would have to write down in your notes or put it in your brain as to what is a 1231 asset. You're only looking for two things. Is it used in a trade or business? Is it held for greater than a year? Two tests. If it's not one of those two things, it's not a 1231 asset. Okay, so this summarizes all three of those scenarios. So that's scenario 1, 2, and 3, based on those examples. So the first one, you'll see the depreciation. This is the total depreciation. So this is the initial cost down to its adjusted basis. If my sales price reaches into that depreciation element, that's the first example we went through this morning, late morning, 71,342 of ordinary income, because my gain was less than my depreciation, my accumulated depreciation. The second example was I filled up the entire depreciation recapture, and I had 10,000 incremental above that, real appreciation. These are all ordinary in the middle, and then the top is the only one that gets capital, my arrows on the right. And then the last example we went to showed the loss. I actually sold it for less than my adjusted basis. I don't have any. But I think if you kind of compare and contrast those, that'll keep depreciation from being so abstract. Okay, so once I know the amount and character or gain or loss on each 1231 asset exposed during the year, I need to net the gains and losses in a particular order to determine if they have an overall net long-term capital gain or ordinary loss, right? These are my two options for 1231 assets, my best of both worlds. To date, we have been talking about one asset gets sold. That's extremely rare, right, in a tax year. In a tax year, you usually have multiple assets, so we have to deal with, I have multiple transactions, multiple of those examples. I have to put them all together because I have to report what number up to on this particular thing. So after I apply the depreciation recapture rules to each 1231 asset, which is recharacterizing what would otherwise be capital as ordinary to the extent of that accumulated depreciation. The remaining 1231, so we're looking for the pure 1231 components. Get to that number, those gains and losses for each asset are netted together. like if I did those three examples we just went through in a given year, I had 1231 on the second and the third. I had 10,000 on one, I had a loss on the other. I had to put those together, right? And have one number I report. So, if the netting process results in a gain, okay, it constitutes a long-term capital gain, which is taxpayer favorable, as it provides access to preferential tax rates applicable to 1231 assets held by owners of flow-through individuals, flow-through entities by individuals. Okay? If it results in a net loss, it constitutes an ordinary loss, which is taxpayer favorable as well as a loss for the offset of ordinary income. Okay? The best of both worlds is the way I think of 1231 assets. So think of that second example we went through. I think I had a $10,000 1231 gain because it went through, it was 10,000 more of gain than accumulated depreciation. Then I had a loss in the last example. The loss was greater than the gain, so I would be down here. And I would have a net loss. Net the two together, but the character of the netted number is a loss because it's bigger. Right? So, if you think about that within the year, so we're doing this within a current year. So just think of a calendar tax year. January 1, December 31, all my asset disposition, I'm netting between the two. Well, it's the best of both worlds. So what if a smart taxpayer says, well, why don't I sell all of my gain assets in this year, and I'll sell my loss assets next year. Right? Now I've just like supercharged the best of both worlds because I get the best on each side grossed up instead of netted down. Okay? So taxpayers could seek to do that by timing the recognition of those losses and to manage the netting of gains that would otherwise occur. If I do it within the confines of one tax year, I have to net. I don't net across tax years, but for this look-back rule. Okay? This look-back rule limits the benefits of timing losses and gains in separate tax years by managing the netting process. Specifically, the look-back rule requires taxpayers that recognize a 1231 gain in the current year to recharacterize that current year income as ordinary income to the extent the taxpayer recognized 1231 losses in the prior 5 years. I have to look backwards. If I have a 1231 gain, right, I would normally put that as long-term capital, but I'm forced to look back to 5 years. And did I have a 1231 loss? It would have been ordinary. If I answer yes to that, then that gain in the current year has to be ordinary. It's less than the prior 5 years of losses. Okay? Example 313 is Edmund again.
So in one question, it talks about suppose that items of the great business in year one, that it recognized a $7,000 net of 1231 loss in year one. Assuming that the current year is year 6, that item reports a net 1231 gain of 25K of the year, and then did not recognize any 1231 gain or losses during the year of 1225. Year 6 will be the ultimate character of the 25K net 1231 gain. So according to the last slide, it says that if there's a 5 year, in the prior 5 years, we can reverse this loss and then recategorize the amount into the ordinary income. So basically, it was 25K. The first is to allocate 7K into the ordinary income to offset the loss, and then the rest of the 18K we recognize as a loss.
Yes. So it's just trying to deal with that objective netting within 1 year. And so trying to have a rule that addresses taxpayers who might have, and again, from an objective standpoint, might have timed the recognition of gains and losses in separate years to get a supercharged benefit of the two. What it does is it works against that opportunity of doing that. What if?
And then in the what if scenario, assume that the same facts as above, except that Titan also recognized a $2,000 of net 1231 loss in year 5. For year 6, what will be the ultimate character of this 25 net 1231? So in this case, in addition to this $7,000 net 1231 loss in year one. There's also a $2,000 net 1231 loss in year five. So in total, it will make this into a like a $9,000 like a net loss in 1231. So similar to the first question, we first need to offset this $9,000 by allocating a $9,000 net ordinary income, and then that will be.
So just, that's just adding an element that I had two losses in there. Okay, perfect, thank you. Okay, so I think this is an important ethical question. So Emma operates a real estate development company and wants to sell some of her business equipment for a piece of land, and a piece of land that is used as a parking lot for her business. She expects to realize a $10,000 loss in the equipment and a $15,000 gain on the land. She's talked to her accountant, has learned about the look-back rule of 1231 property, so she's well advised. Doing this before she does the transaction. You do the transaction, then you're just rolling the dice. What are the rules? So have a conversation before you do the transaction. And she learned about this look-back rule. To avoid any negative effects, she's decided to game the system and sell the land this year and then sell the equipment early next year. So she is going to sell the gain property first and then sell the lost property second, which is the opposite of the rule we just went through. Okay? What do you think about her strategy to avoid the look-back rule? Any reactions? What she's doing, ethical or unethical? What?
I would say ethical, but there's probably a catch. The IRS, it seems like the IRS always has a mechanism to offset that kind of behavior.
Okay.
But I would say it's tax planning.
Okay. Anybody else? Ethics is a personal decision. You can't be wrong. Okay, so I think what this is explaining is they wrote the rule we went through, the example we went through. It was ordered in a particular way, right? It did not cover the inverse. She read the rule, talked about it, and decided, well, if I do the inverse, is there a rule? The accountant would say, no, it's not a specific rule. Oh, I'll do it that way. The question is that unethical? I would argue that is the function of having the power of the pit. What is it for me to second guess Congress? You wrote the rule the way you wrote it. I should be able to read it. And I gotta guess why you didn't want to write the inverse? Have a similar rule? Because I agree, that would make sense. Just have a look back rule at total and try to measure this netting over multiple years. But they didn't write the rule that way. So that's just my personal view, is I take a hard line. And if you want the benefit of you can always change the law and you can write it, whipsaw me or not, then I should be able to read it and apply it. And if you didn't cover that, then you didn't write it very good. Right? So, but that you run into this kind of all the time in a tax code. Is that, should I sit there and guess what people were thinking when they were making a rule at a particular time? Or am I allowed to read the law and set my facts in accordance with what the law says and what it doesn't say? Everybody's, it's not just tax laws, it's all laws, right? In the tax world, that's kind of at least my perspective. I think this is appropriate, smart. The Congress could always, if they found out about this, they could go in and change this and write a new law. From this day forward, if you do it this way, you're also caught. That's the benefit they have on how to empower the bank. Okay, so here's a chart of everything we talked about. If you want to just kind of think about it, and again, I think it's good sometimes to zoom out and look at things from 30,000 feet instead of being in the weeds and working through all the rules. So I have 1231 gain property and 1231 lost property, right? What's 1231? Used in a trade or business held greater than a year. I can only have a gain or a loss. Never So first I have to do gain, I have to do depreciation recapture, right? Because some of that gain could be created by just pulling down initial basis to accumulate, or to adjust the tax basis. Then I have net remaining 1231 gain, I net remaining 1231 gain with any 1231 losses. If it is a loss, then that is ordinary loss. If it's a gain, then I have to look to, that's the look back rule. A gain, I have to look back to losses. Emma went loss before gain. She went half this. And then you get the long-term capital. Both of these are good guys at the bottom. Those are taxpayer favorable. That's the benefit of 1231 gains and losses. Okay? So I just conceptually, and you have to get to this with the amount realized less adjusted basis to gain realized, and then is it recognized? That's on top of this. All the first slides of this material. Okay? Okay. So that's it on property dispositions in a business context that give rise to gains and losses. Okay? Now we're going to talk about what would be in the middle. I have a gain realized, so I have an exchange. I have an amount realized that is greater or less than my adjusted basis. What would keep me from having it be recognized? It's realized, but what would keep it from being recognized? So we're going to talk about 5 tax-deferred transactions. Again, if you were in individuals, you should be familiar to. So the general thing you got to think about is nearly every realized gain or loss is going to be recognized. Okay? Again, power of the pen, the default is they're going to make you recognize, especially if it's income. Okay? Under certain circumstances, I'm allowed to defer the recognition of gain or loss until a subsequent tax year. So deferral is not forgiveness of tax. It's just saying not this year. Okay? Deferral just means I'm not going to tax it currently. I will watch you or monitor you in the future. If you do something else with that asset, then I will tax that previously realized gain that I did not recognize in that year. Okay? So it's not a forgiveness or an exclusion for all times. It's just saying not now. Okay? And in the premise behind deferral is usually twofold. The rationale as to why the government doesn't tax currently some realized gains that they otherwise could have. I think it's good for not just knowing what these 5 transactions are, but understanding why. It's just easier to me than memorizing rules, is to kind of have build an intuition over time as to, well, why does it make sense that they've given deferral in this? There's usually 2 reasons. One, you're in a similar economic position before your realized transaction and after your realized transaction. The easiest one to think about is when you are not in the same economic position. If you have a piece of property, whatever that is, and you have a realization event where you exchange that for cash, you are not in the same economic position. You had stock investment, you had a piece of machinery, you had anything before, and after, now you have cash, right? An illiquid asset to a liquidest asset you could possibly have. Liquid is the most liquid asset you could possibly have, right? So then you're not in the same similar economic position. But what if I start trading one asset for a similar asset? At a realization event, but if they're similar enough, Congress might say, okay, this is not enough. This is not enough to tax this in the current year. I'm going to defer my right to tax this until something. That might be a reason we get deferral. The second one is, typically, if I do one of those transactions, I may not have the wherewithal to pay the tax. And think of wherewithal, how am I going to pay it? Right? The government only accepts cash for tax payments. You can't pay them with Bitcoin or anything else, piece of property. It's cold hard cash, right? So if I do a transaction and I have not exchanged something and received cash, then I have a cash flow problem. If the government taxes that, I have to have another means of which to find cash, or I have to go sell something to raise cash, right? don't know if any of you are following the billionaire tax that's being kicked around in California. But that is classic this issue. Now, it's rare because a billionaire usually has more flexibility than where they access cash. But the concept is they would tax unrealized gains. California has a lot of entrepreneurs and Silicon Valley, and people might have massive net worth but very little income because they haven't done a realization event yet and sold all their assets. If I start taxing them on their unrealized gains, then I have this wherewithal problem. Now, again, that's not a great example because nobody's going to feel too sorry for these people if they have to go out and raise cash, but if I don't have the transaction itself generate the cash, then the government, as a general matter, is concerned about how do I not put the taxpayer in a bad position. So that's the wherewithal concept. So usually it's one of those two things is the reason, either there's not a significant change in the property or I don't have the wherewithal to pay tax. Yes, sir.
I read something, and it could be wrong, but it was that some of the billionaires were like moving their assets to other like regions to avoid that.
Yeah, on the pregame stuff for the Super Bowl, I saw an interview with the San Francisco mayor, and that's what he was concerned about. It's like, if you implement a law like this, you're just gonna push these people to go elsewhere, because they have opportunities to do their next venture somewhere else, right? And if they do that, then do I lose all the jobs and the creativity and the charitable, endeavors that these people might have? So are you, yeah, you're collecting some income, but are you hurting yourself on the long run by doing that? So yeah, those are all factors as well that come into this type of thing. So there's a lot of moving parts in policies like this. These things have come up before, trying to tax unrealized wealth appreciation, but the U.S. has typically been on realization events. We need to have an exchange before we tax it. Okay, so we're going to cover 5 different types of tax deferred transactions. We're going to have elements that are kind of running through them, which is going to highlight the deferral mechanism and how the U.S. protects itself. We're going to do like-kind exchanges. That's real estate transactions. Involuntary conversions. It's involuntary, so you have a realization event, but not something you necessarily wanted to have, right? It happened to you. Think of natural disasters, those types of things that happen. Installment sales, this is when I sell property in exchange for a note that gets paid over time. And business formations and reorganizations, kind of my favorite part of corporate taxation. That's when you're doing transactions within the business, kind of moving assets around, but there's a whole segment that we do not tax. We do not recognize those transactions, even though they're realization events. That's M&A activity. You can have taxable M&A, you can have non-taxable M&A. We're going to cover that in subsequent weeks. And then losses on related party sales. If I have losses on transactions and the buyer and the seller are related, you should be skeptical of whether you're going to get that loss, because the government's going to be skeptical of whether you really, truly have disposed of that asset if you're selling that to a related. Okay, so we'll go through each one of these in turn. So like-kind exchanges. Taxpayers involved in a business may have valid reasons to exchange or trade business assets with others for similar business assets. Okay. Think of trading land used in a business for different land in a better location. Like, I have this apartment building, but I wish I had that apartment building. If I can get a deal structured, I don't have to sell mine and acquire that one. What if I just find who owns that and see if they would exchange that with me? And guess what? There are companies out there that work in the middle of that and help match buyers and sellers in these transactions. Taxpayers exchanging property for similar property realize a gain or loss, right? So we're going to be very methodical. I realized this because what I owned before, I don't own after. It is different. But I'm now at the recognition determination. Is it sufficiently different that I'm going to recognize this? Just as they do by selling property in exchange for cash. However, taxpayers exchanging property for similar property are in a different economic position than taxpayers selling property in exchange for cash because they have not changed their economic position drastically as they hold similar property. Right? That's that first element of maybe Congress will give me the ability to defer this gain. It's not the same as if I sold the land and I got cash, right? Nobody's gonna be sympathetic to me that I shouldn't pay tax in that situation. But if I swap land and I get land back, wow, it's still land at the end of the day. You're gonna tax me on that? And they do not provide the wherewithal to pay the tax, right? Land for land is not generating any cash. If you're gonna tax me on that, then I gotta go find some cash. Okay? Being considered in the bubble here, being considered like-kind property refers to a similar nature or character as opposed to the same grade or quality of property. Okay? So we're not talking about the high-end mall exchange for the high-end mall. We could be doing a strip mall or a high-end mall, right? Or 10 strip malls for a high-end mall. Whatever those types of things. So it's just similar in nature, not the grade or quality. So taxpayers exchanging property for similar property defer recognizing gain or loss. That's important. Not every exchange is a gain, right? Amount realized less than adjusted basis might be a loss. If I meet the like-kind exchange rules, I'm deferring the loss. I normally don't like to defer losses. Okay? We'll talk about how you ensure that you don't defer a loss in a moment. On the exchange, if certain requirements are met. And that's commonly referred to as a like-kind exchange. So like-kind exchange is one, real property is exchanged for like-kind real property. Personal property is not eligible. Okay? We're talking about real estate. And things that are attached to real estate. Apartment buildings, condominiums, office buildings, those types of things. Land held for investment, those types of things count. But not personal property. So not stocks, not bonds, not machinery. What we just talked about before, like 1231, that's the world that's in. Okay, so it needs to be real property, and both the old and the new real property are either held for investment or used in a business by the taxpayer. Note, a taxpayer in the business of buying and selling real property is considered a dealer and is not eligible. So, if you are, all you do is you are buying and selling real estate, if that's your business, that real estate is effectively your inventory, right? It's not used in your trader business. It's not held for investment because you're going to sell it, right? And so you're carved out of this. So what we're really looking for, think of a operating business. It's a manufacturing company and they have a warehouse. And that warehouse doesn't meet their needs anymore. They want that warehouse over there. And I exchanged that old warehouse for that warehouse, right? That real estate used in my business, right? I don't normally buy and sell warehouses. Right? I make things, make widgets and sell things. So that's what we're looking for here in number 2. And number 3, certain timing requirements must be met. The IRS has broadly defined that any kind of real property may be exchanged for any other kind of real estate under the like-kind exchange. So I could take an apartment building and exchange it for a warehouse. If that's real property, number 1. Number 2, if they're held for investment and used in a trader business. Okay, so it's pretty broad. Ring fence to real estate, but within real estate, pretty broad. I just can't be in the business of buying and selling. Okay. So my timing requirements, that third element. So the first 2 is just factual. They have to be there. So if I meet the first 2, then I have timing requirements. There is flexibility in timing of the exchange because a simultaneous exchange may not be practical or possible. If you've done a real estate transaction, it's not something that happens quickly. Real estate, again, I view as special because it's a finite resource, right? And historically, land is very important. So even if you're buying and selling a home, that's just not something that happens like snap your finger, I want to do that by Friday. It's not going to happen by Friday. And that's because there's all these filing requirements, and usually with your local county or municipality, that government agency is involved with who owns that real estate. Are there any claims against that real estate? Are there any liens against that real estate, like somebody worked on it and hadn't been paid yet? They filed a lien against that. All of those things will determine who has proper title to that real estate. So if you're trying to convey that title, sell it to another person, the other person wants a clean title. So there's all kinds of lawyer work that gets involved there, and then there's the government interaction with that. And I think it's just because real estate is a finite resource and special. Not like a piece of machinery. The government doesn't care. You want to sell a piece of machinery, so you don't have a lot of title issues with that. But real estate, not so much of it. Okay? So we have flexibility in the timing because when you're ready to transfer your real estate, we'll call the old real estate, or the new real estate, those timings are going to be in a different process, right? One might be in a different state than another state. One might be very complicated, apartment building. One might be a deserted piece of land that's really simple to deal with, right? So how do we affect an exchange that's not going to happen simultaneously? So we have flexibility in the timing. So taxpayers must identify the replacement property within 45 days of their sale and receive that real property within 180 days. So if I am going to exchange property, I'm going to get new property in, I have to identify the new property within 45 days of exchanging the old. And then I actually have to get it. I have to get title ownership within 6 months, 180 days, right? And third-party intermediaries work on this and help this because they're trying to get paid for being a matchmaker, picking a buyer and a seller. So if I have an inventory of buyers and I know what they're looking for, and I have an inventory of sellers, I can match them and then I get paid. And I can help manage these time because they know these things. They know these rules inside and out because they're trying to get a tax-deferred transaction. They know that the parties don't want to pay tax on these exchanges. They're going to meet all the requirements to pay the tax. So, remember when I said if you have a loss and you meet these rules, you're deferring the loss. You might not want to do that. How do you recognize the loss instead of deferring the loss? Don't meet these rules. The same thing we talked about in that ethical question. These are objective rules. If you fail the 45 days, fail the 180 days, you cannot have a lifetime exchange. So purposely fail it. So if you wait till 46 days, is that unethical? The law says 45 days. That doesn't mean 46 days. If I'm in front of a judge, right? And that's just an objective test. And so they chose an objective test. It is within 45 days or it is not, right? So plan your affairs accordingly. So if you have a gain, you want to meet the rules. If you have a loss, you might not want to meet them. Okay. And then going through these third-party exchanges, there was a court case where the rules didn't allow that, and the taxpayer was trying to get the intermediary to count. So my transactions with the intermediary, I should look through to the ultimate replacement property, and taxpayer won that court case. So now they call it, you might be able to call it start-period exchanges. That's after the court case. Okay, let's do timing requirements. 314 is negative. Okay.
Suppose that on August 4th of year one, Esteban transferred a piece of real property that he was holding as an investment to a third-party intermediary with the intention of exchanging the property for another suitable, similar investment property. By what date does he need to identify the replacement property? It will be 45 days after the original transfer, so by September 18th of year one. And then, assuming he identifies the replacement property within that 45-day time period, by what date does he need to receive the replacement property to qualify for the like-kind exchange treatment. And it'll be January 1st of year 2 because it's 180 days from the original August 4th transfer date.
So, a couple things, it has to be real property, and it has to be holding it as an investment or using it for your business, right? That's the first two requirements to get in the door. The third requirement was the timing, so don't be fooled if somebody tried to do something nefarious and it wasn't real property. And I gave you all these facts and asked you for the timing, you guys jumped to the timing, I got it, it's not real property, you're not in the rule. Okay? So just be methodical, it's gotta be all three of them. Okay, tax consequences of exchanges involving solely like-kind property. So in a very rare situation where my property and the property I want to get are of exact value. You tell me how often that happens. I don't think that happens very often. Real estate's got all its different characteristics. So the chances of the values being exactly the same, I think, are rare. But this is trying to illustrate the point of when they're not the same values. So taxpayer does not recognize gain or loss in the exchange. So I've met all the requirements. Real estate, used in a trade or business, held for investment. I met the timing requirements. Nobody recognizes gain or loss by virtue of like-kind exchange. Congress says in this instance, we defer taxation. How does the government protect that this is not a forgiveness of tax, just a deferral of tax? And that's by how we assign basis to property. Okay? Whenever I have property, however I come to be the owner of the property, I have to take an initial basis in the asset, right? And if it's depreciable, then I take depreciation, I get the adjusted basis. But I have to set up my initial basis. How do I do that? I take what is called a substituted basis in a like-kind exchange that is deferred taxation. So what that means is the basis of my original real property is the basis in the replacement real property. I substitute my old basis into the new property. Okay? Taking a substitute basis in the replacement real property ensures the taxpayer's deferred gain or loss is reflected in the difference between the fair market value and the basement in the replacement real property. So it's built into the new real property that I have, awaiting recognition upon any subsequently fully taxable transaction involving the replacement real property. It's not a forgiveness. I don't get a fair market value basis in the asset. My built-in gain or loss that I had in the old real estate is in the new real estate. So that if in year 2, year 3, year 10, I sell it, I'm going to recognize that gain. The government says, oh, okay, that previously deferred gain, now you did something that is fully taxable. I am now going to tax it. Okay? Substituted basis is how we do that. That is not carryover basis. Remember individuals, and we'll talk about this when we get into M&A stuff here. Carryover basis means the basis that the other party had carries over with the asset. If I take the other owner's basis in the asset, then I've lost sight of my deferred gain in the asset, right? Government doesn't care about that. That's their problem. Your deferred gain is the built-in gain or loss in the asset. Fair market value less your basis in that real estate. Since I exchanged the same fair market values, I need to assign my old basis and substitute that for the new basis, and that preserves that deferred gain for future recognition. Okay? Which may never happen, right? Deferral is fantastic. Why taxpayers like deferral? Because I can defer something for 100 years. If I never dispose of that replacement real property, never recognized. Doesn't mean that the deferral is not still attached to it. It doesn't go away. Just I have to do something affirmatively to trigger that recognition. Yes, sir.
So for all the 5 tax deferred transactions, we always check the substituted basis.
As a general matter, well, not necessarily. Yeah, I would say yes. The reasons I'm pausing a little bit is the involuntary conversions, because that's really not another party. That's like, I think of that as like Mother Nature. Like if something gets destroyed via a tornado, yes, I do take a substituted basis. So that was giving me a little bit of pause, but I think largely you will have a substituted basis in this matter. Now, I do think you won't have that here in number 4. There'll be a carryover basis when we do that. We're gonna cover that in great detail in subsequent chapters when we do M&A. There'll be some carryover basis. And I'll constantly be contrasting substituted versus carryover. It took me a while where I kind of fully grasped which is which at a certain point, so we'll make sure we get to that. Okay. Okay. Let's solely like time. So 315 is Jeremiah.
Uh, 315 says, Henson trades land worth 29,500, tax basis of 18,000 for land in a different location that is also worth 29,500.
So that's solely like kind, right? So the rare fact pattern is the 2 pieces of real estate are exactly worth 29,500. So with the example.
How much gain does Henson recognize on this exchange? The answer is 0. 10 exchanges qualify as a like-kind exchange. The 11,500 realized gain, 29,500 amount realized minus 18,000 tax basis is preferred. What is 10's tax basis in the new land? 18,000 in the basis it had in the old land.
And so remember, recognition and realization, those are 2 separate questions, 2 separate computations, right? So he did realize the gain in the old land because he made an exchange, or the company made an exchange. But the question is recognition. That's what we're talking about now. Do we qualify for the right kind of exchange? And I put in the box here, the way, if you get confused on the basis, whatever basis you want to put on the new asset, assume it was sold the next day. So assume fair market value doesn't change within a day. If I sold the new land for its fair market value, $29,500, and I put an $18,000 basis on it, right? That would be an $11,500 recognized gain. Does that equal my realized but unrecognized gain on the like kind exchange? And the answer would be yes. So then that gives you some comfort you got the right basis on the land, right? An immediate sale is like a check computation. Okay, now let's contrast this with the more likely scenario where the exchanges do not involve solely like-kind property. 2 pieces of property, the parties want to exchange them, but they're not the same fair market value. And these are going to be unrelated parties. Nobody's going to give somebody the extra value for free, right? That's not the way the world works. Somebody is making up the difference, and usually the difference is made up with cash, right? I want your real estate, you want mine, but the values don't quite equal. Somebody's got to fill in the gap with cash. So in that scenario, when cash or other property, so it's not just cash, it could be other property, but I think for all intents and purposes, let's think it's cash. That is referred to as boot in the tax world. That's extra value to get the fair market values to equate the values exchange. The exchanging parties have additional tax consequences as the transferor of the boot, the party who gave up the cash, is essentially purchasing a portion of the replacement real property. And the other side of that, the recipient of the boot is essentially selling, right? If I do all boot, it's a purchase and a sale. If I do some boot, make up the delta in the fair market values, then somebody's partially selling and somebody's partially buying, right? And so that's when I have this situation, and the presence of boot in an otherwise qualifying transaction does not completely negate the taxpayer favorable application of the like-kind exchange. So this is not a scenario where they have to equal value. That it just means that some of the transaction is going to be taxable, but it doesn't blow up the entire transaction. We'll talk about an M&A transaction where we do a stock for stock exchange, and the law there says it's solely stock for stock, meaning that if you had $1 was added to that transaction, it completely takes that transaction out of that provision. That's not this. Yeah, and I think that's just practical, right? Because that first example we went through doesn't exist in the real world. You had to have that, you have much less like-kind exchanges in the world than what we have. So you have to have that flexibility. Okay, so the tax consequences to the parties, and I think you have to think in terms of the two parties here. If you conflate the two, it's going to get confusing to you. So first, let's take who is departing with the cash. Who is the transferor of the boot? Right? If you're giving the cash, you are partially the buyer. Right? So when boot is part of a like-kind exchange, the asset received by the transferor of the boot is recorded in two parts. A portion of the replacement real property received in exchange for the like-kind property, and a portion of the replacement property purchased with the boot. Bifurcate the transaction because you're giving up two assets to get one. Part that you sent, portion you received because you gave up cash is a purchase. The other part is going to qualify for the like-kind exchange. The other side of that transaction, if you happen to be advising both parties, or you're advising the party that is the recipient of the boot, then they have gain recognized by the recipient of the boot equal to the lesser of the gain realized of the boot received. Okay? If I receive cash, that's going to violate one of the fundamental rules on is a gain realized stay non-recognized. If I get cash, the government says, one, those are not similar assets, and two, you clearly have the wherewithal to pay the tax because you just got cash on the transaction. So who's receiving that cash is going to have some gain recognition. Okay. So, and we'll do these in examples in a second. So the basis and the replacement property in the transaction. When boot is involved in a like-kind exchange to equate the values, each party to the like-kind exchange needs to account for the boot exchange in determining their basis and their respective replacement real property. They cannot simply take the substituted basis because cash transferred hands. So one party recognized some of their gain. So you can't just take pure substituted basis because then that wouldn't account for some of the gain being recognized. Some of the other one purchased it, so they need to get some basis for the purchase. Okay? So this is the table that you have to have to compute the basis on these parties. So first you start with substituted basis. What's one's basis in their exchange property? Then you add the boot you pay, less the boot you receive, and then you add gain recognized by the taxpayer. That becomes your basis in the replacement property. This will always work for you, no matter which side of the transaction you're on. You just got to plow through it. But it's basically these two things here is accounting for the boot that comes between the parties because the boot is going, if you get boot, you need to have basis in the boot. Effectively why this is in the calculation. And then that gain recognized, if someone recognizes gain, then you get basis when you recognize gain. So it's a long way of saying you got to follow this calculation. Okay, so let's do 316 and then we'll apply that. 316 is Flora.
Because that can sell land with a value of $29,500 and a tax basis of $18,000 for land in a different location valued at $27,500.
So right now we know somebody's going to put cash in the deal because the two values do not equal. Right? Third parties, I'm not going to give you an extra $2,000 just because. So someone's going to depart with cash. Okay.
What gain or loss did you realize on the exchange? What gain or loss was recognized on the exchange? So the first step we calculate gain realized. The amount realized includes the fair market value of new land, which is $27,500, and the goods received, which is $2,000.
Yeah, right. Because remember, when we started this material, what's my amount realized? It's anything in value that I receive. Teton, what did they get? They got land of 27.5, and they got $2,000 of cash. That's all amount realized, right?
And then minus the adjusted business is $18,000. So the gain realized is $11,500. And next, we determine the gain recognized. So in kind of like can exchange involve both received, the gain realized is the lesser of both received or the gain realized. So which is only $2,000.
Yeah, so it's a lesser of test. So gain realized was 11.5, but I only got 2,000 in cash. So this is kind of that wherewithal question, right? I can't pay tax on the full realized gain. I only got 2,000 in cash. I only sold $2,000 of this, so that's the amount of gain that I
And what's the character of
So this is starting to piece together the whole thing, right? I computed the amount of the gain recognized. I started with amount realized, adjusted basis, went through the like-kind exchange rules, and then I have a gain. That's the amount I'm going to put on the tax return. But what's the character of that? Remember, 1231, is it used in a trade or business held for greater than a year? The answer would be yes if you go back through all the examples and you find those facts. And that means it's 1231 gain. What does that mean? Best I can ever get on a gain is long-term capital. If this was the only asset, then it would be characterized as long-term capital.
Suppose the same fact as above, except that the tax basis for the land was only $9,000. So the total amount realized remained the same, but the adjusted basis changed to $29,000 now. So the gain realized would be only $500, which is less than the full received $2,000. So the gain recognized is only $500.
So that's the mechanic of the lesser of rule. Is I don't want you to recognize more gain than what you realize, right? That's counterintuitive. You don't recognize more gain than you realize. In that hypothetical, they had a basis of 29,000 and they sold it for 29,500 was the amount realized. You can't recognize more than you realize. Even though you've got some cash. Okay, perfect. Thank you. Okay, so 317. This is going to be assessing the basis of this. Asia.
Assuming the facts in example 316, where Bitcoin exchange land with a value of 29,500 and a tax basis of 18,000 for another land valued at $27,500 and 2,000 in cash. Now, Teton recognized $2,000 of gain on the exchange. What is Teton's basis in the new land it received from the dealer? The answer is 18,000. And it's computed with the fair market value of new land and adding to that the amount realized from both, totaling 29,500. Now we deduct the tax basis of the land 18,000 and we realize gain of 11,500. And we recognize $2,000 of gain, which is the lesser of the two, or the gain realized. Now we defer gain of 9,500, which we get by deducting the gain recognized. We get by deducting the gain recognized from the gain realized, and then we get the basis of the land, 18,500.
And so the 18,000, so let me go through that with this example, okay? So my substituted basis, that's the basis I had in my original land that I exchanged, that was 18,000. The boot paid was 0, because they were not the payor, they were the recipient. Boot received is 2,000. So I take 18,000 less 2,000. But gain recognized, I add back in. I recognize 2,000, so I add back to 2,000. My answer would have been 18,000 if I applied the chart. And that's the answer here. Now I put in the green box. This is where I think an immediate sale could be helpful to check, because it's like, okay, did I do all that right? Because there were things moving all over the place. Well, if I immediately sell the replacement property, what's it worth? It's worth 27.5, right? Because I got cash of 2,000. So I sold the replacement property for 27.5. I want to put a basis on it of 18,000. What would that gain recognized be on a day 2 sale? That would be 9,500. That equals my deferred gain remaining of my realized gain that I did not yet recognize. Right? So I feel some comfort that, yeah, I tied it all together. Okay? That makes sense? Got to plow through it mechanically. Okay, thank you. Okay, let's do our second section, involuntary conversion. So you may involuntarily dispose of property due to circumstances beyond your control. So think natural disaster, accidents, something is stolen from you, it's condemned, seized via eminent domain, an action by the government to take your land for the greater societal good. If you happen to own land and they want to put an exit from a highway, they can make you sign it if they go through the court process. These give rise to involuntary conversion. So you converted, you had a realized event, but it wasn't something you affirmatively did. It happened to you, right? So oftentimes taxpayers receive insurance proceeds or replacement property in excess of their adjusted tax basis on the property. So think about if you had a hurricane, right? Those happen. If something happened and somebody lost their home or something, they're going to get insurance proceeds. If it's a business, you might get replacement property, whatever you insured yourself from that particular loss. So that is a realization event, right? You had something, it's gone, you got something new. You could have a hardship if they are required to recognize a gain on that transaction and pay tax. So they are allowed to defer realized gains on involuntary conversion. So I think of this as the government doesn't want to pile on to somebody who is already having an issue for something that was not their choice to do. So we are not going to make something that is realized by a function of an involuntary act and then try to tax affect it, right? I think we probably all agree that that seems a little too much. Start certain tax on everybody that hit by a natural disaster. So, but we're deferring it. We're not forgiving it. Right? So you can imagine where we're going to go. We're dealing with basis, right? Yes, plus.
Would inheritance fall under this?
No. So an inheritance, although involuntary to you because you couldn't control what happened to somebody who passed away, it's different than an involuntary conversion. You got to think. I think involuntary conversion is either Mother Nature or the government coming in, not something coming into you. So a taxpayer's recognized gain on an involuntary conversion is equal to the lesser of the gain. So this is recognized, the gain realized on the conversion, or the amount of reimbursement the taxpayer does not reinvest in qualified replacement property. This is a rule trying to account for the insurance proceeds. Okay? If you are fully insured and the insurance company writes you a check and you decide not to reinvest that in this similar property to get back to where you were, you've had an exchange at that point in time, right? And the government thinks, okay, that's no different than a sale. You could have sold it and got it for cash. Instead, it got wiped out by a natural disaster, and you got cash and you chose not to rebuild it. That looks like a recognition transaction. It's different than a replacement to get you back to where you were.
What's like the time frame someone has to reinvest in a qualified replacement property?
That's a great question. I do not know what that is. But you see these things all the time where they do a federally declared disaster area. That's when they're qualifying that destruction is eligible for this involuntary conversion. And I'm sure somewhere embedded in that law, there's a certain amount of time. Because, you know, the tornadoes here, there's still people dealing with that. It's like taking forever. And so there's got to be some flexibility on doing that. But I just don't know what those rules are. Okay, let's do 318. 318 is Simran.
Okay, great. So, assume that one of Teton's employees was in a traffic accident while driving a delivery van. Everybody involved escaped without serious injury, but the van was totally destroyed and unusable. Before the accident, this delivery van had a fair market value of $15,000 and an adjusted basis of $11,000, because the accumulated depreciation on the van was $4,000. So Teton received $15,000, so that costs the fair market value of the van of insurance proceeds to cover the loss. And now they're considering two alternatives for replacing the van. So alternative one is to purchase a new delivery van for $20,000, and alternative two is to purchase a used one for $14,000. So the question is, what's the gain or loss that they recognize under alternative one and two? So basically, should I just walk through the bottom part?
Yes.
Okay, yeah, so first you have to kind of calculate the gain realized, so that's the amount realized minus the adjusted basis. We know the amount realized is the fair market value at $15,000, and the adjusted basis, as stated, was $11,000. So it gives us a gain realized at $4,000. And then to that, you consider the insurance proceeds as well. That was $15,000 under both scenarios. However, the proceeds reinvested in alternative one, since the van is $20,000, you're reinvesting all of the proceeds, so that's the full $15,000. But in alternative two, the delivery van is only $14,000, so you're only reinvesting that much. So then you get the difference between the two.
Yeah, so let me pause you there. So what I think about alternative two, they're effectively cashing out a portion of it, right?
Yeah.
They're keeping $1,000, and you probably have friends or somebody who did something, tried to fix their car on the cheap and kept some of the balance of it. But that's effectively what's happened here, is they didn't fully reimburse that. They were entitled to the full insurance proceeds. That's fine. The government just said, well, that extra $1,000, you can pay tax on that extra $1,000.
Yeah, so that extra $1,000 is the amount not reinvested, which is the gain recognized for alternative two. In the first option, there's no gain recognized because the full $15,000 is used. And then you calculate the deferred gain. So the deferred gain is a lesser of either the gain realized and the gain recognized. So, it's the gain realized minus the gain recognized. That's $4,000 for alternative one. And then since you pocketed that $1,000 is $3,000 for alternative two. Then the value of the replacement property we know was $20,001, $14,002. So then you subtract the deferred gain from that, and that gives the basis of the replacement property at $16,000 for alternative one and $11,000 for alternative.
So this goes to Arthur's point, is it straight substituted basis? And the answer is no here, because I'm forcing the basis. I'm forcing the last line on that table to be 16,000, 11,000, so that I embed a deferred gain in alternative one and two equal to the deferred unrecognized gain. So I can take insurance proceeds and buy the brand new replacement van, right? I can buy a very expensive replacement van. So its value is very high. So the way I preserve the deferred gain is I got to get the basis up to where the deferred gain is still latent in the asset. And so that's why it's 4,000 less in alternative one and only 3,000 less in alternative two. Okay? Basis is the key in deferred transactions, to not forgive the tax but preserve it for future years. Okay? So we'll finish up the rest of this, and then we're going to go back to the last part of chapter 4, where we do, and it's our last topic that's across business entities, and then we're going to dive in next week on your appropriate. Okay? Thank you.
Oh, not bad. How about you? You watch the Super Bowl at all, or?
I watched it.
Really?
You watched it.
Yeah, well, I went to his house and I was like, this is like the most boring game of all time, I'm leaving.
Yeah, I already, even in the first half, you can tell you knew which way it was
I mean, at least like
going.
the Chiefs and the Eagles, like,
Yeah, it's competitive.
but well, it was like 42 to what, 20.
High scoring, yeah.
But it's like Mahomes could turn this game around at any time.
Yeah, that's what they said. Yeah, we did the sign-up sheet.
But if I kept repeating
Probably just thinking out loud.
anything within 1 to 6,000.
Real estate taxes, so